Good afternoon. Today is Friday afternoon, July 7, 2023. I'm Joe Terril, President of Terril & Company, Private Wealth Managers, St. Louis, Missouri. Thank you for viewing another one of our video updates concerning our thoughts on the world economy and the investment markets. We have been talking for the past year about the fact that the world economy is stronger and would continue to be stronger than what a lot of prognosticators were talking about. We said no recession. Those things are playing out. Very true. No recession. Economy is staying strong. This morning, employment figures in the United States echoed. People are getting pay raises. There are plenty of jobs, and the economy is strong. Outside the United States, the economy is not as strong as ours, but nonetheless, they're not falling apart either. The consumer around the world is carrying the day. With that said, one of our other themes is interest rates are not going down. If anything, they're going to go higher. That is coming out now. In the last few days, U.S. 10-year government bonds are trading north of 4%. The Fed is talking about raising interest rates at least a couple more times. We're having no trouble finding riskless investments, if you will, to yield 6% and in some cases even north of 6%. The other and third and final theme we've been talking about is inflation is not getting ready to go back to 1.5–2% anytime soon. Those figures are also being borne out in investment markets and in economic news. Inflation is being very stubborn. We are actually in the camp that sees inflation beginning to pick back up and move higher. So the 9% inflation that's come down to 4 to 5%, instead of going on down to 2%, we think it actually has a better probability. It's going back up to 5, 6, 6.5%. We anticipate this will be led by higher energy prices, higher wages, and higher homeowners equivalent rent, whether it's home mortgages or rents. So put that economic news together, we continue to believe we're going to see higher interest rates. Higher interest rates are not good for the stock market. Yes, I know the market's had a heck of a rally, but it's been dominated by just 7 high-tech stocks, are 85% of the move. I've been asked by clients, well, why don't we buy those? And even though they're priced way too high, there's no risk-reward measures there that you can get excited about. And the answer to that is because the bottom can fall out of those stocks at any time. Those stocks go up on a staircase, they come down on an express elevator. If there's any news of any kind that's negative, they can fall apart in a hurry. And witness, even with the nice rally that they've had so far in 23, you haven't made back what you lost in 2022 yet. So we're finding good values in other issues, and in particular with our average portfolio yield now all in is probably somewhere close to 6 3/8, 6.5%. That's made up of treasury bills, believe it or not, in the 5 3/8, 5.5 level. But beyond that, floating rate issues are paying 8, 8.5%. Even some of the more high quality bank names like JP Morgan are still paying close to 7%. We'll take that. That's not bad. It's not a permanent home for us as far as investments go, but it's okay. We are holding our gold stocks, we're holding our basic industry companies. They will perform as time goes along, and with the tremendous cash flow these companies are generating, something good will ultimately happen. So we are still being defensive and feel that in the second half of the year, strong economy, higher inflation, and higher interest rates will not be an ideal investment scenario for either long-term bonds, any type of fixed income with a duration, or the stock market in particular, not for these high-tech glamour stocks. So we appreciate you tuning in today, and thank you to Brian Curtis for producing our video. We'll be back shortly, or as events merit, with an update. Thank you.